Hi everybody, my name is Elias and this is Investing Club, and in this video I want to show you what I do to check if the dividends of a stock that I'm looking at are safe. And a bunch of companies have been cutting their dividends lately, and so a question a lot of people have: I own this company, is its dividend safe, or are they going to cut their dividend? So in this video I will be answering those two questions. Before we get started, smash the thumbs up button for the YouTube algorithm, really helps out my channel. And now let's get right into the video. Okay, so right now the website I'm on is Finviz. I'll put a link down to it in the description, and I have Apple pulled up. Now Apple is probably one of the least likely companies to ever cut their dividend, so I'm going to use them as an example of what I look for looking for companies with safe dividends. Now coming down to the information about Apple, the first thing I like to look at is their payout ratio, and that is down here. Their payout ratio is currently 23.9%. And the payout ratio is basically the percentage of Apple's earnings that go towards its dividend. In the past 12 months, Apple has earned $12.76 per share, and their dividend per share is $3.28. So you can see that the dividend payment by Apple is a very small percentage of their total earnings, only 23%. But that's not the only thing I like to look at, because something that's more important than the payout ratio, in my opinion, is if the company has the free cash flow to cover the dividend. And what is free cash flow? Free cash flow is basically the cash left over from a company after the company pays for its operating expenses and its capital expenditures. So essentially all of the leftover money after the company pays off its expenses and makes its capital expenditures, any money left over is free cash flow. And what I really look for when I look for a company that's not likely to cut its dividend is that free cash flow, the amount of free cash flow per share covers the dividend paid per share. And this is because the free cash flow is essentially leftover money for the company. And so theoretically, the company can pay out all of their free cash flow as a dividend, and it wouldn't hurt their business at all. So the safest dividends out there right now are probably companies that are generating the free cash flow to cover their dividend. Now, Finviz gives you the price to free cash flow ratio, which is right here. It's around a 25. And so from that, you can quickly determine the free cash flow per share of Apple. All you have to do is take the price of the stock and then divide it by this price to free cash flow ratio. So the price of Apple right now is $307.71, and then you divide that by the price to free cash flow of 25.5, and that gives you $12 per share of free cash flow that Apple generated in the past 12 months. And then when you look at the dividend, and the dividend is only $3.28. So the dividend is only around 25% of Apple's free cash flow, which makes this, in my opinion, an extremely safe dividend, and a dividend that's unlikely to be cut. Again, just because even if Apple's earnings fall and even if their free cash flow falls by 50%, they're likely still going to have enough to safely pay the dividend without really impacting their business at all. Now we can take a look at another company. We can take a look at Bank OZK. If you've seen any of my videos, that is a stock. That is one of the stocks in my portfolio. And again, the first thing to note, payout ratio is only 27%. So only 27% of this company's earnings are being paid out in the dividend. But more importantly than that, I want to see the free cash flow cover the dividend. So their price to free cash flow is only a 5 right now. So this company is being valued very cheaply right now. And so to find the free cash flow per share, we take the share price, which is $19.67, and then divided by 5. So this company makes around $3.93 of free cash flow per share in the past year. And their dividend is only $1.08. So what does this mean? This means that even if the earnings and free cash flow of the company drop 30%, 40%, 50%, the company most likely will still be generating enough free cash flow to safely pay the dividend without impacting their business in any meaningful way. And that's a reason why I'm a huge fan of this stock. They recently just increased their dividend again. So in a time like this where so many companies are cutting their dividend, Bank OZK is increasing their dividend and expects to do so for the rest of the year. Now, I'll give you an example of a company that has what I would not consider a safe dividend. And we can take a look at, for example, Exxon Mobil, that is ticker XOM. And what is the first thing we see? Payout ratio, 130%. So right off the bat, that's a huge red flag. This company is paying out 130% of its earnings for its dividend. And that is something that, while it could be fine in the short term, is very likely not sustainable in the long term. So when you see a company that has a payout ratio of over 100%, that probably means one of three things. First, this company has to cut or reduce the dividend. And if they don't do that, if they keep paying the dividend, then they're either going to have to cut expenses in other places to be able to afford the dividend payment, which could impact their business in the future if they're not making the investments they need. Or two, they'll have to take out debt to pay the dividend, which I do not like. I would not like it if a company I own took out debt to pay a dividend, because that's just kicking the can down the road. It'll save them for now, but a few years from now when that debt comes due, that's when it'll be a huge problem for the company. And in addition, price to free cash flow, they have no price to free cash flow ratio because in the past 12 months, ExxonMobil has not generated any free cash flow, which makes sense since they are a capital intensive industry and have a lot of capital expenditures every year. So what does this mean? Well, plain and simple, it means ExxonMobil's dividend is not safe. Now, that being said, will they cut it? That's up in the air. I don't think they've said anything yet. Their dividend yield is currently over 8%. But if you were looking at investing in stocks just for the dividend, ExxonMobil is not one of the stocks I'd be looking at, because I would say that it is not sustainable for this dividend to continue to be paid in the next few years, unless, like I said, either A, they start generating more earnings, or they cut their costs somewhere else, or they take on debt to pay their dividend. So those are the two things I like to look for when determining if a company has safe dividends. That is the payout ratio and if the free cash flow covers the dividend. If you learned something from this video, hit the like button, subscribe to the channel if you haven't already. I post videos about the stock market multiple times a week, and I will see you on the next video.